Welcome back to Traders Corner, our real-time, real money, real trade trading show. As always, Garth McKenzie talks us through his portfolio picks, and he's, of course, the founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, it's been quite a quiet session for markets over the last few weeks. The volatility seems to have seeped away almost entirely, so it's quite interesting how people are complaining about this. They complain when there's too much volatility, they complain when there's not enough. What's going on at the moment?
Yeah, look, at the moment, volatility is very, very low across the world, really. We've got the VIX, which is the volatility index in the States, that's gone down below 15%, and it's gone down to a 5-year low. And historically, what has happened, every time the VIX has dipped down to such low levels, it often precedes a market correction. Now, not to say that that necessarily is going to be the case now, but the VIX is sort of known as Wall Street's fear gauge. So when it's very low reading like this, it indicates that the markets are fairly comfortable and fairly complacent, possibly. And when volatility readings are high, it indicates a fairly high level of fear in the markets. So we've got a situation at the moment where we've got very, very low volatility, as I said, the lowest in 5 years. But we've got the month of September coming up, and there's a lot of potential market moving stuff that's going to happen in September. We've got the Fed widely expected to announce some sort of stimulus, but whether they do or not is actually still a debate, and there is potential for the markets to be disappointed there. And similarly with the ECB, they also are widely expected to come with some sort of bazooka effect after Draghi's bold words a few weeks back. And he needs to come and sort of put some flesh on the bones of that plan. And again, if he can't, if he disappoints the market, there is room for potential. So potential for disappointment, rather. So I think, you know, September could be quite an interesting month, and I wouldn't be surprised if volatility picks up from these very low levels that we're sitting at right now.
Of course, it's also got to do with people coming home from summer holidays, sinking into depression because they know they've got to work for a living, so that may have an element to do with a bit of a sell-off in September.
Sometimes it can happen, yeah, but certainly you're right, we're right in the very middle of that sort of holiday period in the Northern Hemisphere at the moment, with the midsummer there, and this tends to last until around about mid-September each year historically. So it's not uncommon to see the markets as lackluster as they are, and as with such low volatility like it is right now.
Okay, we're sort of setting up to this week's trade, but before we talk about it, I know that you do want to quickly revisit some of the two former trades that you've put on for the portfolio, AngloGold Ashanti and also Coronation Holdings.
Yep.
How's AngloGold Ashanti playing out? Yesterday was a bit of a smack on the gold index, but it was particularly Harmony that came under pressure. Is AngloGold still sort of holding up for you?
Yeah, AngloGold is fine. It did come under pressure yesterday along with the rest of the gold shares, but it's actually holding up okay otherwise. If you have a look at the chart of it, it is up on the screen at the moment. What I said last week was that we had a large double bottom there at around about 250 Rand, and what I felt is that this is potentially the start of a new leg up for the gold shares. We had a nice strong move up from 250 to about 285, and then we had a consolidation during the first half of August, which is identified there by what that is a bull flag pattern, basically. And it broke out to the top, and usually with these bull flags, what you do is you take that height of what is called the flagpole, and then you project it up from where from the bottom of that flag structure, and that gives us a target of about 315 Rand. So what I did for our portfolio last week was I bought us 500 CFDs at a price of 276 Rand, whilst that consolidation was still happening, because I believed it was going to break out to the upside, which it has now done. The stop loss is 269 Rand there, which is still quite a long way down. And at this stage, I'm happy. I mean, notwithstanding yesterday's weakness in the gold shares, that breakout is still valid. The shares are up again today. They're doing relatively okay today, these gold shares. So I'm still comfortable with this trade. I'm still going to stick to it. Remember that we only risked 1% of our capital on the trade, so it's not I haven't gone into it with big aggression or with big risk. But I'm comfortable with it. I'm going to stay long here. I still believe that this trade looks fine in my eyes.
Okay, so this is an open trade. What about Coronation?
Yeah, Coronation also interesting. We did this trade 2 weeks ago. Really what we had was a nice steady upward trend there, going back to join all the low points from the beginning of June. And then we also had this overhead resistance, which was at about 30 Rand. And my feeling at the time was that if it punched out through 30 Rand, we would see quite a nice powerful breakout through the top of that resistance, and then it would go on to about 32 Rand as a target. So what I did is I bought 5,500 CFDs for our portfolio at 29 Rand 60, and we're using a stop loss there at 28 Rand 30. Now, it did push up above 30, but it's come under a little bit of selling pressure over the last few days. It's not worrying me too much at this stage. It's not anywhere near violating our stop loss at this stage, so I'm going to stick with this trade. But having said that, it has been a little bit disappointing that it started to break out and didn't actually follow through, which is it's a pity. But let's see how it goes. I'm going to be staying with this trade for the time being. I'm still fairly comfortable, and I still do think there is potential for the stock to break higher, unless we see some sort of a wobble in the broader markets. But we've got our stop loss in place there anyway, so I'm going to sit tight here.
Okay, so Coronation and AngloGold Ashanti are open. You've initiated a new trade this week, which is fairly complex. You've done a couple of these before. Tell us about it.
Yeah, it's a put spread option structure on the top 40. So to basically lay the groundwork for this trade, I'm going to have a look first at the chart of the top 40 index and just show you what's happened here. The graph of it is up on the screen. What you can see there is we had stiff resistance at 30,800 on the top 40 index, and we punched out through that in early August, and we've gone all the way up to about 31,500 on the top 40. So it's been a nice, powerful breakout. It is very overbought, however, if you look at that stochastic oscillator on the top. And my sense is that we might possibly get a little bit of a pullback from here, just given that we've run hard. We've run about 2,500 points in a more or less a straight line without much of a pullback. So I think there's room for a little bit of a pullback here. Also, as I said, bear in mind what's coming up in September. We've got the ECB, we've got the Fed, and there's a huge amount of expectations in the markets at the moment, and if those central banks fail to deliver the goods, there's a possibility that we see sort of a third quarter, September or October type correction in the markets. So what I want to do is I want to actually just create some sort of protection down at the lower levels as indicated by that circle there, and I'm doing it with an option structure. And what I want to make clear here is I'm not turning bearish. By and large, I think this setup actually is very bullish, but I think there's room for a little bit of a consolidation, possibly a slight pullback in these markets. And obviously there's the risks of all this stuff happening in September. So what I'm doing is I'm putting a structure in place that will give us protection into that area that I've talked about there. But if we see that pullback, there's a good chance that I'm actually going to want to buy for a fourth quarter rally in the market. But I'd like to have this structure in place as a hedge. So if you like, I'm putting a hedge in place with the view to the market possibly pulling back, and then that will allow me to buy slightly more aggressively than I would otherwise, because I know that I've got the protection on the lower end.
Okay.
So
tell us how it works.
All right. So how it works is like this. This is a chart. Well, this graphic has the levels of the top 40 index along the bottom there, and it has profit and loss on the y-axis over here. Now what I've done is I've bought two put options with a strike of 30,000. Okay, and I'm paying 8,780 Rand for each of those. So what it means is that I'm outlaying 17,560 Rand for those two put options. Now bear in mind, each point on this top 40 future, which is the underlying instrument of these options, represents 10 Rand per contract. So because I've done two of them, it's 30,000 times 10 Rand, which is 300,000 Rand per contract, times 2, because I've done two of these. So effectively, I'm taking an exposure to 600,000 Rand with this put option.
That sounds massive.
Well, the thing is, it's our portfolio sits at 365,000 or there and thereabouts. So certainly it provides us with some leverage. But remember that I'm doing another leg to this trade, because by doing this, paying 17,500 Rand for a put option with a strike of 30,000 is all very well, but it gives me participation all the way down to zero, and I'm paying for that participation all the way down to zero. And the market, as we know, doesn't go to zero. It's never going to go to zero. So what I then do is I sell another put option with a lower strike, and this is where the spread part of the put spread name comes into play. And what I've done there is I've now sold 4 options with a strike of 28,500 each, and there I'm receiving a premium because I've sold these options. So I receive the premium in this case, and I'm receiving 4,733 Rand for each of those options. So you multiply it by 4, and what it means is that I then receive 18,932 Rand in total for those 4 options. Now, as you can see, what I'm paying out on the one option is offset by what I'm receiving on the other. In fact,
you're making a small profit.
Yeah, I'm actually making a small profit. So if you overlay these two payoffs against each other, you get what looks like that on that yellow line, which is your put spread option structure payoff. So if I clean it up a little bit, it looks like that. And what it really, if I break it down into its simple components, it means that anywhere above 30,000 on the index, I'm actually going to receive a premium. I'm going to receive 1,372 Rand. So I'm actually being paid a little bit to put this structure in place. All right. At 28,500, I make the maximum profit on this structure of 31,371 Rand. So what you can see...
in other words, if the market retraces to 28,000, that would be the maximum profit point for you.
Correct. That's what it would be. But bear in mind, as I said, I'm not turning bearish on the market. I'm putting this in place because it's effectively free protection. It's actually better than free because I'm receiving a little bit of a premium in my pocket for it. But it gives me participation from 30,000 down all the way down to 27,000. So that allows us to basically weather a correction of about 13% from where the market currently is right now. And I'm very doubtful that we'll see that. But it's quite nice to know that I've got this protection in place. It costs me nothing. And if the market were to retrace a little bit from this level, from these very overbought levels that we're at now, I can then buy against this structure, and I can buy slightly more aggressively than I would otherwise because, as I say, I've got a nice exposure here. And the hedge is effectively in place. So that's what I'm really trying to achieve here. If we go back and have a look at the graph of the top 40 index once again and just look at and try and overlay that previous payoff structure onto this chart of the top 40 index, what it really means is that we've got that situation there. So anywhere here above 30,000, I receive that little bit of premium that we spoke about. Then below 30,000, I start to make a profit. 28,500, I make the maximum profit, and then that profit starts to dwindle away a little bit from below 28,500. And only below 27,000 will this structure start to lose money. So if we basically have a look at the different levels, there you can see the significant strike points. 30,000 over there, 28,500 over there, and then 27,000 at the bottom. So it gives us really nice protection in the event that we were to see a little bit of a pullback here. But I just want to stress the point, I'm not becoming a bear. I'm really just putting this in place because I like to have that protection at the lower levels. It certainly gives me a lot more confidence to do some buying for a potential fourth quarter rally in the market.
Garth, the fact that in the past when you have put these put spread options into play, you've normally paid out a little bit of a premium. The fact that you're getting one this time around, does it almost suggest that you're fairly unique in taking out a structure like this, not in expectation, but protecting against a market correction of the magnitude you've spoken about, say 13%? It suggests that there's not many people overly worried about such a correction. Because if they were, this kind of protection, this kind of hedging insurance would be a little bit more expensive, I would imagine.
You're 100% right, and it comes back to what we were talking about at the beginning of the show, the levels of volatility. And at the moment, volatility levels are very low, and hence buying this type of protection is relatively cheap. And that's exactly what we've got here. So you're right, on previous or in previous quarters when we've done a structure like this, I've ended up having to pay a little bit away for that insurance. But in this case, because of the shape of the volatility curve at the moment, I actually end up receiving a little bit of premium here, which is, I suppose, a bonus.
Yeah. Well, on that note, let's see what the portfolio looks like at the moment.
All right, this is what it looks like given the trades that we've got open currently. So we've got our put spread structure on the Aussie 40 there open, which we've just discussed. Then below that, the Anglo Gold trade is still open, and we've got a mark-to-market profit there. And the Coronation trade also still open, and we've got a small profit there. The trade is becoming a little bit frustrating, but we're going to sit tight with it for the time being. So our portfolio is sitting at just over 363,000 Rand, so it's up 45% for the year to date.
Still a fantastic performance. Garth, to end off with, as we always do, just talking about your courses. I know you had one this weekend. How did that go?
Yeah, we had one in Johannesburg this past weekend, and it went very well. We had 20 delegates, so the course was full. Great bunch of people, and a great day was had by all. So all good. The next one is on the 13th of October, also in Johannesburg. Anyone that's interested in attending this course is welcome to email me or get in touch with me on Twitter or Facebook, and I'll send you the information on the course. I know there's a lot of people out there in Durban and Cape Town and other areas that want want me to go and present, and I will be doing that in the final quarter of this year. I'll be looking to set up courses in Cape Town and Durban and probably in George again as well.
Well, you'll obviously keep us posted as you go along. Garth, thanks very much. We have to leave it there, but we'll be chatting to you next week.
Thanks.
That is Garth McKenzie, the founder and editor of Traders Corner.